In this video, I'll be looking at Volume 1 of Frederic Lane and Reinhold Mueller's Money and Banking in Medieval and Renaissance Venice, focusing in particular on the relationship between what they term the standards of value and the media of exchange. This will help us to understand the role of coins and precious metals as bearers of value in the Middle Ages more broadly, and will demonstrate how notions of payment were not restricted to the exchange of such precious metals. As Lane and Mueller begin their book by saying, "The connections between coins and monies of account raise questions that are central to many problems of medieval monetary history. The conventional definition of money as a medium of exchange and a standard of value dodges essential questions about that relationship by assuming that one thing performs the two functions, although conceptually and historically the two are separable. Moreover, both medium of exchange and standard of value are sufficiently ambiguous to make moneyness only a matter of degree." They go on to observe that any denomination used in contracting obligations and keeping accounts might logically be called a money of account in a broad sense. The expression money of account is well established in the literature. It will be used here to show that a standard of value is involved. Some historians call money of account only those denominations of account, serving as standards of exchange value, that do not refer to coin in use, although sometimes they have the same names. Carlo Cipolla called monies of account ghost monies, because these denominations of account did not in the main refer to anything visible and tangible. It enabled him to emphasize correctly that the values attributed to the two monies, the real coin and the ghost, were not the same. Such ghosts play very active roles in Venetian history. The exchange of money was deeply interwoven, as one would expect, with social history in medieval Europe. In the Middle Ages also, custom as well as law determined which means of payment were so widely used that they functioned as media of exchange. Paper money circulated only in China, and in Europe cheques were not generally accepted. Metallic coin was the chief means of payment, and governments declared some coins to be legal tender, others not. The extent to which the legal tender was supplemented through custom by other means of payment varied greatly from place to place. There was much offsetting of one claim against another even in country villages, but only in busy commercial centres such as Venice could debtors make payments by transfers of bankers' promises. Some other forms of credit were also transferred to meet obligations, but credit was far less important than coin. Although monies of account varied from place to place, in the Latin West they shared a common ancestry, so to speak. In much of Europe the names of the units of account used in evaluating coins were derived from the monetary system created by Charlemagne. The Carolingian reforms provided for the coinage of only small silver pieces, called denarii, of which 240 were struck from the pound weight, the Roman libra. They declared that 12 of these denarii should be equal in value to 1 Roman solidus. Accordingly, 240 denarii equals 20 solidi equals 1 libra, and these denominations were used to indicate standards of value, although no solidi or librae were then coined. The system was adopted in Saxon England, and it survived in Britain as pounds, shillings and pence, until their meanings were changed by the adoption of the decimal system in 1971. With the dissolution of the Carolingian Empire, control over coinage passed to local authorities. Feudal lords, communes, and territorial princes minted pennies of various weights, fineness, and insignia. Many different librae came into use in keeping accounts. Each libra was counted as 20 solidi and 240 denarii, but each had a different exchange value. At first that value depended on the amount of silver in the particular denarii, the only coins issued, of which 240 composed the particular libra. Later other coins became important in determining the relative values of the many different librae and solidi, pounds and shillings. Sometimes the denominations of account, librae, solidi and denarii, were directly equivalent to the coins minted by a principality or kingdom. This was the case in medieval England, where denarius was the Latin name of the penny coin, and solidus referred to 12 pennies, libra to 240 pennies. But before long most countries used, at least to some extent, coins whose names were different from those of the denominations of account. Moreover, the monetary denominations used in contracts were recognized in law as having continuity of meaning, even though both the name and the content of the coins in common used as payment had changed. England was rather exceptional in this regard, which is understandable given its unique position as an island separated from the mainland. This enabled the English to limit the exportation of precious metals to a minimum, and to carefully police any foreign coins entering the country. As we shall see, control of the circulation of coins was of great importance in maintaining the commodity value of the currency, that is to say, its metal content. Monies of accounts. In 1934, historian Hans van Werveke had defined 3 conceptions of money of account. Type A represented a definite weight of gold or silver, usually previously embodied in a coin. Type B was based on a coin in use, whether silver, gold or billon, and Type C was imaginary money, absolutely independent of any real money, that is, of any coin or fixed quantity of precious metal. Type C, he maintained, did not describe any historical reality. Italian economist Luigi Einaudi defended a more theoretical view of money in the medieval period. The key to understanding earlier monies was, he declared, the distinction between a monetary unit used in contracts and a monetary unit used in payments, that is, the distinction between what may be called money as a standard of value and money as a means of payment. This is also the distinction between a monetary unit used as a standard of value or of deferred payments and a monetary unit used as a medium of exchange. In the 14th and 15th centuries, the English used only one money of account and changed its metallic base only slightly. Florence and Milan, like Venice, used several monies of account based on different coins and on different bimetallic ratios. But since those cities abandoned efforts to maintain a single monetary standard, embodying a fixed bimetallic ratio, they soon settled down to the use of 2 monetary standards, one based on silver, the other based on gold. Given the distinction between the standard of value and the medium of exchange that has been articulated, we typically find coins being minted in silver or a mixture of silver and copper. As Lane and Mueller write, these developments gave Europe a trimetallic monetary system, in that there were 3 kinds of coin to be evaluated in money of account: black money, white money, and yellow money. Debased pennies, along with the many issues of half pennies and even smaller denominations, were called black because they were composed largely of copper and quickly darkened. The alloy from which they were made was usually less than 1/5 silver. White money, in contrast, revealed its high silver content by shining white when rubbed. If it turned red when rubbed, revealing a copper content, it was said to blush for shame. The yellow money minted in Western Europe was as nearly pure gold as was technically feasible. If we exclude the copper content of these more debased coins, we have essentially a bimetallic system, employing gold and silver. This must be distinguished from a bimetallic standard, if only because the ratio of comparative value between these 2 currencies fluctuated so much for various reasons. For instance, if a large quantity of silver were mined and a king were eager to mint more silver coins for circulation, the relative scarcity of gold would increase its value and widen that ratio of value difference between the 2 metals. Lane and Mueller state that, with bimetallic ratios changing as much as 20% within a decade or 2 during the later Middle Ages, the export of undervalued coins repeatedly destroyed efforts to maintain a stable bimetallic standard. As a result of the distinctions thus far elaborated, bookkeeping tended to record the mere standard of value, as opposed to the actual means of payment. This is especially important considering not only the variety of goods, services, etc., but also the diversity of coins. A list of the coins changing hands in a transaction in Normandy in 1473 is illustrative of the diversity of coins used in large payments in the later Middle Ages. 9 kinds of coins were itemized, including many French gold écus, 2 English gold nobles, some English groats, many of the various French silver coins of about the same value, some Flemish and German silver, and some silver issued by the Duke of Brittany. Each variety was carefully rated in livres tournois, that is, the French denominations of account or ghost monies, and the total was rounded off to 400 livres by adding 7 shillings 2 pence, described only as white money now current. In smaller transactions, including wage payments, black, white and yellow money were all probably used when they were available. Debasement of coins. As we have seen, in the Middle Ages the association between monetary value and the medium of exchange was not rigidly kept or stabilized. This was perhaps largely a result of the debasement of coins and their fluctuating silver content, which made strict metallic standards continually elusive. One reason for this was purely material. As coins changed hands, they were liable to be rubbed down in size and even chipped when transported, and as a result coins long in circulation inevitably lost a considerable percentage of their weight, and with it some of their commodity value. This would of course cause problems over time, considering the devaluation was not reflected by any change in denomination of the coins. There was also a deliberate variety within the currency of particular principalities, because of the minting of denominations smaller than the typical unit of silver coins, which as such would have incorporated a greater amount of copper. These halfpennies and other such denominations were perhaps more akin to small change, but it can be imagined that they paid for cheap goods and essentials among the poorer classes. Because of these fluctuations and this variability of metal content, it was common to talk in terms of good and bad money. In spite of the prevalence of the feudal legal conception, the feeling that metallic content determined the real value of money was reflected not only in the extensive use of payment by weight rather than by tale, that is, by adding up the denominations of coins, but also in the possibility of adjusting prices according to the kind of coin offered in payment. Lawyers cited text from Roman law requiring that whoever had borrowed good wine must repay with wine of similar value, not new wine for old, and applied the same principle to debts contracted by exchange of coin. Debtors should pay back money of the same goodness as that received or contracted for. Seigniorage. Not all of the coins minted by the authority of the time would go into circulation. Rather, a portion of those minted would be taken as a kind of tax or payment by the authority. This principle was known as seigniorage. As Lane and Mueller write, for many medieval rulers, especially the several princes crowded closely together within approximately the area of modern Belgium, their mints became a major source of revenue. The existence of independently directed mints within short distances of each other led to many wars fought with coins instead of swords and spears. Each prince tried to coin as much as possible so as to increase his total receipts from seigniorage. The competition between mints sometimes took the form of cheaper products, that is, of coins inferior in fineness, but similar or even identical in appearance to those of a country into which they were introduced. That kind of competition was considered an act of hostility, close to armed conflict. The prince who succeeded in getting his inferior coins accepted in neighbouring countries could increase the flow of precious metal to his mint. In that trading system as a whole, the bullion flows were only occasionally dominated by the efforts of princes to increase their revenues through manipulation of mint prices and the fineness of their coins. Short-term movements of specie were occasioned by the need for coins as ready cash for military outlays or, especially at Venice, for the preparation of seasonal commercial voyages. In the long run, precious metal was attracted to mints in countries that regularly offered for sale commodities in demand elsewhere, as were the tin, wool and cloth of England, or in countries that after years of good harvest had surplus of grain for export. The balance of trade itself depended on the exchange not only of commodities but also of services. In applying to medieval and early modern Europe the dictum that to obtain precious metals, a country without mines had to export more goods and services than it imported, it is necessary to stretch the meaning of services. In medieval and early modern times, services included military activities that were hardly distinguishable from plunder or piracy, like that by which the admirals of a heroic naval tradition added to the money supply of Elizabethan England. Important also in balances of payments were the ransoms that kings or lesser warriors who had been captured in battle had to pay for the service of being released, as well as the tolls or gifts that international traders paid in many forms for protection or for the benefits of not being plundered, and for advantages that princes gave some merchants over competitors. Between the badly policed and intermittently warring feudal states, the most obvious flows of specie arose from the use or restraint of force in ways that we can call services only ironically, and in order to emphasize the importance of military events in connection with changes in the flow of specie. The extent to which banks in medieval and early modern Europe created credit is even more obscure than the extent to which today's banks do so. The inference that they did create credit, that is, that they did expand the money supply beyond the total value of coins issued and circulating, is based on the proven existence of certain essential preconditions. Bankers operated on a system of fractional cash reserves. They granted lines of credit to individuals, companies, and governments, often in the form of bank money. They sometimes monetized government debt in this way. And finally, they were welded into a banking system by a more or less functional arrangement of interbank accounts. Moreover, the factor of credit creation, combined with the cost of telling the coins at the time of deposit and withdrawal, and the tendency for the demand for coin to exceed supply at least occasionally contributed to the tendency of bank money to separate from its metallic base and to become a new standard of value, as well as a separate means of payment. Businessmen therefore sometimes specified whether a payment was to be made by transfer of bank money or in cash. Bankers could turn the difference, or agio, between the full-weight coins and bank money into a source of profit. In conclusion, what can we glean from this information? With regards to my video on the Templars, this book in some part confirms the hypothesis that banks operated on a system of fractional cash reserves. Of course, this was something that developed gradually over centuries, and as the authors have said, coin was more important than credit. But as we have also seen, services in the form of military might also played a prominent role in settling debts. The fact that the Knights Templar combined both is highly suggestive and merits further inquiry. Another line of investigation this book has opened up is the question of the relationship between the monarch and the money supply. I think this is perhaps the single most important factor in economic history, in spite of the fact it is entirely absent from modern economic considerations. A future video on the philosophy and political theology of monarchy is on my horizon, with special reference to Ernst Kantorowicz's The King's Two Bodies, which is the classic text on the subject. In the meantime, please like and share this video if you enjoyed it, and be sure to subscribe.